So we are looking at the tax implications surrounding the M&A transactions, and I'm sure we've understood a lot in the legal sense. But let's now just quickly understand. Maybe I'll just quickly run through what are the generally adopted modes of restructuring, the key features around the options, and then we get into the details of tax considerations, including the domestic as well as tax issues in the the cross-border deals. Then we'll just quickly look at some of the anti-avoidance measures which the department has taken and what impact does it have on the M&A deals, along with certain other relevant developments. So let's just quickly see what are the need or the key drivers of restructuring. So I'm sure most of these are common, but just to get a perspective of how the exercise of a particular mode or which option is relevant, how does one determine on the same? So we could have restructuring which is driven out of requirement of economies of scale of operations. So for example, where two corporates are in same business line, say operating in a similar business line, and they may want to merge or come together or consolidate to take advantage of the synergies that each one of them has, and especially the large scale operations. So similarly, there could be a requirement of separating the non-core business assets. So this is generally, we've seen this happening, especially where promoters are looking at hiving off or trying to encash the valuation of the business. And generally, you will see promoters hiving off or extracting or separating the non-core business assets so that they can show their commitment and also focus on the core business and increase its valuation. Similarly, surviving through competition. So I think the geo-led merger in the telecom industries that we saw. So that's an apt example. So some restructurings are driven out of competition, and so on and so forth. I think I'll just maybe talk about the last point, the legal entity rationalization. So these we have seen commonly taking place where, say, assuming there is a global acquisition which has happened, and both the groups which have ultimately consolidated at a global level may have their respective entities present in multiple jurisdictions. So ultimately, there may not be a sense for a consolidated group to operate so many entities in each of the jurisdiction, and they may want to rationalize the number of entities. So basically, this means reducing the number of entities or consolidating the business in the respective jurisdictions, which with under various modes. And the objective is primarily to reduce your operating or the administrative cost, and also have consolidation done. So there are, again, now after having looked at the need of restructuring, one kind of determines what is the better mode of implementing or how do we achieve the desired objective. So this could be in various manner. It could be a court-driven process, or it could be a process which is mutually agreed and understood between the parties and is executed through business transfer agreements or under contracts. And some of the restructuring could even be purely internal restructurings which are driven by objectives, say could be of succession planning or right sizing of the balance sheet, which is generally where we generally see options like capital reduction or buyback coming in. So I'm not getting into much details of each of this. We'll look at each of these options in detail in our subsequent slides. But just to before we enter into each of the option, a very high level overview. We have options which are driven by court process, rather through approval by the NCLT, which is the National Company Law Tribunal. So we have mergers, demergers, which are typically the court process, and these are commonly seen options, especially where the intention of the parties is to consolidate or focus on a particular business line without actually exchanging consideration in cash, and also achieving a tax efficient way of the consolidation.
Acromic point.